In 2000, Amazon lost $1.4 billion. Its own annual report had a section heading that read, "We have an accumulated deficit and may incur additional losses." And at that exact moment, it was the best thing you could possibly have bought. You've had the thought, everybody's had the thought, if I'd just bought Amazon. Here's the uncomfortable part. You almost certainly would have sold, and not because you'd have panicked or because you lack some quality that winners have. You'd have sold because the reasons to sell were excellent. They were printed, audited, and filed with the regulator. So this isn't really a video about Amazon. It's about the gap between a return that genuinely existed and the number of people who actually collected it. Because whatever you own right now, you are standing somewhere inside that same gap, and today you find out where. Let's not be generous with the timing. Let's pick the single worst day in the company's history to buy. December the 10th, 1999. The very top of the dot-com boom. $106.69 a share. There is no worse day. If you'd set out deliberately to buy at the most stupid moment, this is the moment. Buy there, never sell, and today your money has multiplied by 49. $10,000 becomes $489,000. That's 15.7% a year, every year for 26 years. For comparison, the whole U.S. market over exactly the same stretch turned 10,000 into about 55,000, 6.6% a year. That is a perfectly good outcome, and it is not in the same postcode. So the prize was real. And you didn't need to be clever to get it. You needed the worst timing physically available, and it still worked. That's the part everybody quotes. Now the invoice. From that December day, the shares went down. Not a dip, not a correction. They fell to $5.97, 94.4% gone. Percentages that big stop meaning anything, so here it is in money. Your $10,000 is now $560. You've kept about the price of a weekend away, out of a year's savings. And here's the cruel arithmetic of a hole that deep. To get out of a 94% fall, you don't need to go up 94%. You need to go up 1,687%. The price has to multiply by nearly 18 just to bring you back to level. A 50% year, the kind of year that gets a company on the news, still leaves you down 91. So how long did level take? 9 years and 10 months. But 9 years is far too tidy a way to say it, because it wasn't 9 years of quietly waiting. Look at where you stood each Christmas against what you paid. End of 2000, down 85%. End of 2002, down 82. End of 2004, 5 years in, still down 59. End of 2006, 7 years in, the company now genuinely working, you were down 63%. That's worse than 2 years earlier. Then 2007 almost brought you home. And then 2008 took half of it away again. 3,600 days of being wrong in public with your own money. It would be easy to sit here and call those sellers weak. So let's actually read what they were reading. In 2000, Amazon sold $2.76 billion of things and lost $1.41 billion doing it. Rounded off, for every dollar that came through the door, about 50 cents went out and never came back. By the end of 2002, the losses had piled up to $3 billion, and shareholders' equity was minus $1.4 billion. In plain terms, on paper, the company owed more than it owned. And that risk heading I read you at the start isn't from a critic. It's Amazon in its own annual report to the regulator. We have an accumulated deficit and may incur additional losses. The first sentence underneath it, we have incurred significant losses since we began doing business. 6 months before the peak, the magazine Barron's ran a cover story on Amazon. They called it Amazon.bomb. And Jeff Bezos' own letter to shareholders for the year 2000 opens with a single word, ouch. Then, it's been a brutal year for many in the capital markets, and certainly for Amazon.com shareholders. Selling wasn't the dumb move. Selling was the well-informed move. Everyone who sold had done their homework, and their homework was correct. There's one more line in that letter worth having. Bezos quotes Benjamin Graham, who is the man who more or less invented reading a company's accounts for a living. In the short term, the stock market is a voting machine. In the long term, it's a weighing machine. And then Bezos adds, there was a lot of voting going on in the boom year of '99 and much less weighing. Which sounds wise and is. It also doesn't tell you a single useful thing about when the weighing starts. In this case, the answer was 2009. So the moral is hold, never sell. Conviction, right? No? And this is the most expensive wrong lesson available, so stay with me. In that same letter, the ouch letter, Bezos writes about the bets Amazon itself had made. Quote, our decision to invest in smaller e-commerce companies, including Living.com and Pets.com, both of which shut down operations in 2000. We were significant shareholders in both and lost a significant amount of money on both. Amazon owned a piece of Pets.com, the single most famous corpse of the entire .com era, the one with the sock puppet, the one they still make documentaries about. Amazon was a shareholder and said so in writing, in the same paragraph where it asked to be weighed. So the people who couldn't tell the survivors from the casualties included Amazon. Last episode, we looked at every company that fell 70% and never came back, and found that 54% of them were profitable at the peak. They looked fine. They had the numbers. They didn't come back, which means have more conviction is not advice. It's a coin toss wearing a motivational poster. The thing that actually decides whether you're still holding in year 9 isn't belief, it's size. And that number you set before anything happens. Say Amazon was 3% of your money. At the bottom, you were down 2.8% of everything you had. That is a genuinely annoying afternoon. It is not a life event. You'd probably still have been there in 2009, mostly because selling wouldn't have been worth the paperwork. Now say it was 40% of your money. At the bottom, you were down 38% of everything, and that was in the same account as your rent. You'd have sold. I'd have sold. Anyone sensible would have sold, and they'd have been right to, because that isn't investing anymore. It's exposure you can't survive. Same company, same 9 years, same 94%. Two completely different lives, and the difference wasn't insight, or courage, or research. It was one number chosen in advance on a calm afternoon by someone who had no idea what was coming. Amazon's return was real, and almost nobody collected it. Both of those things are true, and everything that matters about investing lies in the space between them. That 49 times wasn't paid out for being right. It was paid out for being right and still being there, through a 94% fall, 9 years underwater, negative equity, a magazine cover calling you a bomb, and the founder himself opening the year with ouch. So the one sentence worth keeping, you don't get the return of the thing you own. You get the return of the thing you own minus everything you did while you owned it, and the homework, which takes 2 minutes. Find your largest position, not your favorite one. Your largest, they're often not the same. Now knock 90% off it on paper and look at what's left of your total. If that number would make you sell, then the problem was never the company, and it isn't something to fix in the crash. The size is wrong, and it's wrong right now while everything is calm and nothing has happened yet. This is educational content, not personalized investment advice. Do your own research before putting money anywhere. If this was useful, the like button genuinely does decide whether the next one reaches anybody, and subscribing means you get it. And there's a vote to cast. We've done how much of one company you can hold, and now what holding one actually feels like. Next up is already written index or pick and what that 4% figure means for a normal portfolio. After that, you choose the order. Option 1, the numbers that actually tell you something about a company, the handful worth checking, and the popular ones that protected nobody. Option 2, what a crash costs on the way in, not on the way out, how bear markets actually end. Option 3, the boring portfolio that keeps beating the interesting one. Comment the number. It sets the running order after the next episode, which is a real choice. It's just not this week's.